Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory, and we thought we'd come to you today with a little bit of an update, not really even a market update, more of a long form video on market timing. It's obviously been a rough start, we're far past the start. It's been a rough 2022. We're in the midst of kind of a bear market, recovery from a bear market, depending on how you look at the cycle. And it's not uncommon at this point for us to start to get a lot of questions from folks around, should we be trying to time this? Should we be trying to jump in? Should we be trying to jump out? I'm scared, I'm happy, maybe I got out and I'm looking to get back in. There's a lot of that type of chatter out there. You don't generally get that chatter in years where the market's up, but you definitely do start to see it when markets go down and people start to scratch their head and say, is there any way that I could miss this or that I could figure out a better way to go about it than to just sort of buy and hold and allocate over time? And I thought we'd spend a little bit of time talking about that because it is such a common question. I thought we'd show you a little bit why the experts don't really recommend trying to jump in and out of the market with any real frequency. The problem with trying to time the market is that in order to time it appropriately, you have to be able to know not only when to sell, but you also have to know when to buy back in, right? There's two decisions there. First is, how scared am I? How bad do things have to be before I decide that I actually need to go ahead and move to cash? I can't do that every time the market has a little bit of a red day. And then subsequently, if I've moved to cash or I've sold out of my positions or made myself significantly more conservative, when do I decide that it's time to get back in, right? That it's time to put my money back into the market? And being off on either one of those timing can really be detrimental to your returns in a very large way. And I just note that, most of the time when we think about selling out of the market, it's because we're scared. Something's bad happens, the market starts to sell off, there's blood in the streets. It's the days when CNBC has red all over the screen and we're losing money. And those are the days in which we say, you know what, maybe things are worse than they seem or worse than I think they are. And maybe it's really time for me to sell out. And similarly, the times when we want to get in and buy are normally the times when we feel really good about ourselves, about the market, the market's rallying. And so I put together a little thought experiment game, which is, let's look at what your returns would look like if we played this sort of momentum-based market timing strategy. So market goes up by 5% off its most recent low. Things must be going well. I buy into the market. Market sells off by 5% off its most recent high, then that means that things must be going poorly. There must be some sort of problem out there, and so it's time to sell out. And we'll just kind of roll that through with this notion of, okay, when I feel good, I should buy in, and when I sell out, when I feel bad, I should sell out. And we're going to look at that during the period of time from the beginning of 2018 through the end of 2019, basically a 2-year period. So if we're going to play that game, we come into the year, 2017 was a fantastic year for the market. You're fully bought in. And then right about here was the first time that we ever started to talk about tariffs. So, we started to enact tariffs on the Chinese. The market did not react very favorably to the idea of a trade war, and so it sold off pretty steeply right there around February. And then it recovered a little bit because we were quiet about it, so you bought back in about there because the market was back up 5%. Maybe we were wrong to sell out, but then we brought it back up again right about here. We had a little bit more of the trade war. We doubled down on that trade war narrative. So as a result, you sold back out. Market took a while to recover, had a pretty stable middle of the year. So you bought back in here and you rode up. And we got to this time period here in late 2018, early 2019, when the market just got super volatile. It was a combination of interest rates and were we raising too fast and were we going to kill off the economy or not, along with a whole lot of trade narrative of, doubling down again even further on our Asian and European trading partners. And so we sold off and you sold out, and then the market recovered because it looked like we were back on track. So we bought back in, but then it got really paranoid, and so we sold back out again, and then we looked better again, so we bought back in, and then we fell off a cliff coming into December 24th of 2018. So you sold out here and you missed that bottom portion, which probably felt good. This is that confirmation bias of like, yep, my method is working. I sold out here around 2650, and look how far down we went. You know, we went down to 2400, 2300 on the S&P, and so I must have, my strategy is clearly working. Around about January, the Fed reversed course. They said no more rate hikes, and the trade narrative settled down. So we bought back in here. Good on you. And then we held it all the way until we started to get a little bit more trade narrative here, and then a little bit of re-election worries and what's going to happen. And then we got all the way to the end of the year, and all of a sudden we had this nice upward rally towards the end. So you bought in and you sort of held it to the end. Visually, was this a good idea? No, probably not. The way that I can see it is that if it was a good idea, then the green arrows where I bought into the market should be below the red arrows where I sold out of the market, right? We generally want to buy low and sell high. And in fact, if you followed this, then excluding dividends, you basically made $0 over this 2-year period in the market, when the market actually returned more like 20%. So by trying to get cute and time it and enter and exit in this fashion, you basically left about 20% returns on the table. And I just note the following. Ideally, if you're going to try and make a market timing strategy work, you want to buy in when things look as bleak as possible, when there is absolutely no reason to buy, nothing that you can point to, because that's when the market's scared. And that's when things get on sale. And in general, you also want to be selling out when everything looks perfect, right? Everything's rosy, corporate profits are booming, there are no problems looming on the horizon. That's actually when you want to sell out. And that's what the mathematical process of rebalancing actually forces you to do. It's very hard to do that if there's a conscious decision, because it doesn't feel right, right? It doesn't feel right to be buying when there's no reason why you should be. To be like, yep, I'm terrified. It looks like the economy's collapsing around itself. Now's the time to get in. It also doesn't feel right to be selling when you think everything's rosy. And our intuition works against us in that way. It's also very difficult in a market like this because of what I like to call false bottoms and false tops. So we came into the year right here around 4,800. And pretty quickly by the middle of March, we were down around 4,200 on the S&P 500. So about a 15% drop plus or minus. Maybe you got scared here. Maybe it was, in here somewhere or in here somewhere, and you thought to yourself, oh my goodness, this looks really terrible, and so you sell out. That's all good and well. The question is, how do you respond when the market's back up here, right? Do you look at that point and say to yourself, well, things look like they're fixed, and now I'm missing out on the rally. I sold out down here when it was at 4,300. Now it's back at 45 or even 4,600. It makes me feel like I should get back in. Things must be fixed. And if you buy back in here, then guess what? You get to ride this portion of the curve down again, particularly this portion for a second time, which is what you're trying to avoid. And if you're not careful, you do the same thing here, right? Okay, maybe I've sold out here, but maybe I buy back in here, and then maybe I sell back out again there. It's the visual representation of that green and red arrow chart that we were just showing. It's very hard to know, like, when should I be getting in and when should I be getting out? Most people that do it wind up riding the down portions of the curve twice, okay? It's part of what helps to express this, which is one of my favorite charts in all of the charts that I present on a regular basis. And this is basically the retail performance gap. Okay, and this, you can Google it if you're sitting at a computer. You can look it up. There's a lot of academic research that's on this. It basically covers the following idea. In any reasonable time set, 5 years, 10 years, 15 years, within market returns, you'll see the following pattern emerge, which is large cap stocks. Here we're looking between 2004 and 2013 with a chart that came out of Forbes. Large cap stocks returned 7.4%, bonds returned 4.6%, and the average retail investor returned 2.6%. Okay? Now, here's the problem. There's no mathematical combination of 7.5 and 4.5 that averages to 2.5, right? And so when academics look at this problem, they sort of think to themselves, well, how is it possible? How does your average person wind up with a 2.6 return when they could have had either 7.4 or 4.6 or some combination thereof if they had just diversified their assets and held on over time? Maybe with rebalancing, you can do even a little bit better. And the answer is people make mistakes. They try and time the market. They try and get cute. They try and pick their favorite penny stock or their favorite this or their favorite that. And there's this massive underperformance that exists as a result of trying to make those decisions. And it's really part of what working with your financial advisor is really designed to be the value add around is really not taking the market returns of 7.5 and trying to drive that to 8.5 or 9.5. Really, what you're working with your financial advisor on first and foremost is getting out of this bucket and getting somewhere in here. So anyway, that's our brief take on market timing. To the extent that you have any questions, always feel free to reach out to myself or to your advisor. Look forward to talking to you again soon, and I hope you're having a great day.
Thank you for tuning in, and if you're enjoying this content, please don't forget to subscribe and click the bell so you can keep up to date with everything new at RFG. If you want to learn more about who we are and what we do, please visit our website at rfgadvisory.com.